Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to another edition of the Grain Feed, brought to you by EverAg, your weekly podcast where we talk about all things grain and all things feed to help you, the producer, manage your risk. I'm your host, Jake Kingsley. Joining me today is Kathleen Wolfley, wandering somewhere in Western New York. Kathleen, how are you this morning?
I am spectacular. Jake, before we started recording, we were both talking about oranges. And I just want to tell the audience that if you have not tried a sumo orange, go out to your local grocery store and pick one up. But I feel so much better now that I've had my sumo orange. The sun is shining in Western New York. It's been shining for like 4 days now, which I think is a feat at the end of February. The ice is nearly melted off of my driveway. Life is good. That was a long way to answer your question, Jake, but life is good.
Well, I appreciate the detail, Kathleen. And I am going to have to make a grocery store run here in the next day or two. I had a conventional navel orange, but I'm going to be on the lookout for some sumo oranges when I get over there, probably tomorrow. Before we talk about some things that maybe are affecting your trip to the grocery store, let's timestamp this broadcast really quick. It is right about 11:15 Central Time on Wednesday, February 26th. The markets are somewhat quiet today. We have corn down about a penny across the old crop curve. You have soybeans down about 6 cents. Soybean meal, that stubborn little byproduct, at least over the last week, very range bound here, down just about a half a dollar per ton. Class 3 down 5 to 10 cents depending on the month you're in. Class 4 continues to move lower, and crude oil is down about 15 to 30 cents depending on where you look in the futures curve. Over the course of this week, corn, which had been rallying rather aggressively over the last couple of months, finally took a break, maybe put in its highs at least for the near term. We had the May contract down about 25 cents from its highs when it put in its low on Tuesday, bouncing back a little bit before the end of trading and pretty quiet again here, as I said, down about a penny today. So now that we've laid all that out, I think speaking of going to the grocery store, Kathleen, do you have a little bit of an update on how consumers are feeling as they get back out there?
Yeah, I think that as we finished 2024, the consumer was starting to feel a little bit better. It was a bit of a tough slog through, especially the second quarter of 2024, maybe into Q3. And by Q4, people were starting to feel a bit better. Inflation was starting to ease. I think just overall, folks were maybe feeling a little bit more encouraged about a change in the administration. But here in early 2025, the sentiment readings that we're seeing are starting to slip and split pretty aggressively compared to what we were looking at the end of last year. University of Michigan sentiment readings came in around 64.7 for the month of February, which was well below expectations and noted the biggest month to month drop since June of 2022. So we are in a position where I think overall the consumers are feeling a bit more uncertain. They're certainly talking about inflation as one of those big key bugaboos in the marketplace that I think is starting to influence people's decision making and continuing to influence their purchases as well. Overall, I think inflation from a January perspective, we saw up 3% on a year over year basis, up a 0.5% month to month, which I think was the biggest month to month increase going back to August of 2023. So it's just kind of been a stubborn story around inflation, and folks are growing pretty weary of it. And the inflation story is not just one product or another. Certainly, eggs are a big hot topic that folks are talking about. It's pretty easy to walk to the grocery store and say, yikes, eggs are really expensive. Maybe I'm going to look at a different product today, or I'm going to buy 6 eggs versus the 18 eggs that I would buy on a weekly basis. So there's a little bit of trimming in trying to pull back on purchases as a result of some of this inflation that we're seeing in different parts of the grocery store, in different parts of everyday life, unavoidables like insurance, rents, housing continuing to increase on a year over year basis. So I think that overall, consumers are starting to feel a bit more uneasy as we go through early 2025. And uncertainty tends to zap confidence to some extent. So I think as we think about the dairy markets in particular, we're continuing to see foot traffic in restaurants slide. Menu inflation remains a key sticking point. And we're starting to see consumers making trade-offs in terms of maybe buying a private label versus a branded product, shifting grocery stores based on cost, just as an effort to try to trim costs along their everyday purchases. Jake, how do you think that some of that is influencing the grain markets?
Yeah, I think we've seen managed money flow into the corn market certainly over the last couple months as what folks are starting to kind of pin down as maybe an inflationary hedge. I think you've talked about all of this uncertainty in the marketplace, and there's uncertainty there as well as in global trade and new administration policies and how that's going to shake all of this up. And so we've certainly seen some cash flowing into the ag commodity space here as a hedge against some of that. I think we've seen maybe a little bit of a slowdown in that just here in the last week. We've, of course, had this tariff conversation of a will they, won't they over the last couple of months now. President Trump came in at the start of this week reiterating that he would go forward with the 25% tariff on Canada and Mexico as we get into the weekend and the 1st of March here. That was the expectation at the start of February. And of course, they punted 30 days. It's hard to know if they will stick this time around or if we'll see another delay in that. I think the market probably starts to lose faith in what is being said and starts to definitely believe more in actions if we do see another punt. And I think we've seen that play out a little bit as maybe managed money and others have stepped out of this corn market just in the last handful of days. I think late last week, corn futures kind of saw their top. And over the course of this entire week, we've been down each day to the tune of 25 cents across the May contract there in just a handful of days. I think in addition to that, you've also had South America making really good progress as far as their harvest goes, particularly Brazil catching back up to their 5 year average on their first crop harvest, and thus allowing them to catch up to the 5 year average on planting that safrina crop, the second crop of corn that goes in behind the beans they're taking out now. And that's a big portion of the supply that they export, particularly to China and other foreign buyers. And so for that to get back on track adds some pressure to corn. And then we're also in a state here where the Midwestern farmer is getting very close to, if not already making their planting decisions for this coming crop year. And with corn in the high fours and soybeans for the new crop window down in the mid tens, the price ratio there is down around 2.2 on the value of soybean futures versus corn futures for the similar harvest period. And when you have a ratio as low as 2:2, you tend to see somewhere between 2 to maybe even as high as 5 million acres of corn added to what they plant versus last year's number. And that would, with weather doing its part and producing a good yield, really loosen up these balance sheets, especially as South America gets back on track down there and maybe global balance sheets find a little more wiggle room. So, corn market's at least taking a breather. I think it's a very good opportunity to step in and own what you need in the next month or two, and then reassess if we do, in fact, at the end of March, get an increase in acreage, maybe that finally sets the trend for this thing to work back down into the mid fours and lower yet. Again, a lot of that's going to be weather dependent because our balance sheet now is at 1.5 billion bushels of ending stocks on corn, and that leaves a fair bit of uncertainty. A crop failure can be disastrous at that point, but a big production year for us in the US would take us right back up close to some numbers that we had at the end of 2024. On the protein side of things, we continue to see questions around these tariffs with Canada and how that may play out as far as canola and some of these vitamins and micro minerals that come out of Canada. And China also has a standing 10% tariff in place, which they've filed a dispute with the World Trade Organization, but that is in place. Those are two significant suppliers of micronutrients for our dairy farmers. And so there's questions around some of that stuff. But protein, having added crush capacity and still a healthy balance sheet here, looks to be a good opportunity to maybe move from canola into more US produced soybean meal to avoid the potential 25% tariff on Canada. That's a hedge that a lot of folks are taking a look at. And if you still have to buy stuff through September, the futures and basis across the US have been very attractive. It's a good opportunity to step in and also to start thinking about some new crop purchases. Maybe you're not able to get physical feed bought for October 25 forward. Some places are, but if you can't, it's still a very reasonable place to step in with your first layer of options coverage or some sort of hedge to capture while we're down here. I mean, the new crop curve is somewhere between 315 and 325 a ton. That's a great place to get started. You don't have to do it all, but it's a good place to consider getting started. There's opportunity out there, certainly. These dairies are taking advantage of that in a large part. And I'm curious what you guys are seeing the milk production side of this, with all that's going on over there.
Yeah, I think that's a good question, Jake, because we did see a milk production report on Friday last week for January, which showed milk production up 10% year over year, which was a little bit lighter than our expectations, but still positive and really the first positive number that we've seen in milk production, US milk production since October. California still saw some pretty big hits in January due to avian influenza impacting production during the month. Output was down 5.7% based on USDA's reading for the month. But places outside of California, particularly in areas where we're seeing capacity expansion, did help to offset some of those California losses. Idaho, South Dakota, Texas, all up around 6.5% year over year. Kansas was higher. New York was higher in terms of milk production. So we are seeing growth in other parts of the country that have helped and continue to help offset declines in the West. And more anecdotal evidence suggests that California milk production is picking up as we get into February. Those losses are starting to ease a little bit. February's been a pretty good month for milk production in terms of how the weather is shaking out. So my suspicion is that some of those impacts will continue to ease as we get through the remainder of Q1 and on into Q2 for California. I think one of the big questions now is what happens to avian influenza from here? We haven't necessarily seen major spread outside of California. There's been some talk about Nevada, some talk about Arizona, but no major influences to milk as far as I've seen. But key watch factors would be the Midwest, Wisconsin, the Northeast. We have not seen avian influenza in the Northeast yet, knock on wood. So I think that at least from a psychology perspective and two, from a milk production expectation, we're going to be watching the potential for continued spread of avian influenza. But now with cow numbers up 40,000 head year over year in January, we are starting to pave the road for a bit better milk supply outlook here in 2025. Still, there are potential headwinds. Heifers are limited. What heifers are out there are expensive, but margins are okay. So yeah, we've seen a little bit of erosion in the margin expectations compared to what we were looking at the end of 2024, but I think by historical comparison, they're still pretty healthy compared to history. Production caps that we saw in place over the course of the last several years have been ratcheted back, just as we have seen new capacity coming, and there's an opportunity to grow into these new facilities. So January milk production, yeah, we saw a little bit of an increase in milk production year over year, but the expectation is we will see a return to fairly steady growth in 2025, barring any sort of major disease impact. Another thing I wanted to touch on today, Jake, is what's happening in the markets from a dairy perspective. We've certainly seen a significant erosion in both class 3 and class 4 futures over the course of the last several weeks. And it's an interesting market as we look at class 3 in particular. It's cheese, whey, and butter that are all influencing the class 3 space. And from a cheese perspective, we have seen some pullback in cheese prices here in recent weeks, but for the most part, we continue to stay pretty choppy in the cheese market. Where we've seen a tremendous amount of erosion on the class 3 space is due to whey prices coming down. Whey prices on the second quarter compared to the beginning of the year off about 15-20 cents. We were trading around 75 cents to start the year. Today, futures are trading around 55. Every penny move in The whey price is equal to about 6 cents off of class 3. So we have seen a significant impact to the class 3 space just given the downtick in the whey markets. And it's not a market that we talk about very often. But I think that from a whey perspective, those supplies are not all that ample compared to years prior. We don't have a ton of stocks out there. I think demand has been weak. Folks that needed product had the product that they need. And given the high price, people have moved to more of a hand to mouth type buying. And we have new capacity that's coming online or expected to come online in the second half of 2025. So overall, that market does seem to have taken a bit of a step back. On the flip side, I will note that high protein demand is still very strong. Folks are looking for their ready to drink shakes, protein bars, ready to mix powders. We all must be pumping iron because everybody's looking for protein, protein, protein. Seems like going back to our grocery store theme, folks are looking for protein and you see it in almost every aisle of the grocery store. Okay, let's shift into the class 4 space. We've seen a significant amount of erosion in class 4 over the course of the last few weeks, in part because the fat market is long. We have a lot of butter fat floating around the marketplace in the form of cream. So that's fat that's ready to find its way into a churn or into an ice cream plant or into sour cream production. There's a lot of it and it's cheap. I suspect we'll see a pretty significant inventory build this is Wednesday, in Wednesday's USDA cold storage report for January. I suspect we're going to see a lot of butter in inventory at the end of January. At the same time, powder prices have come down as well, and that's putting a little bit more pressure on class 4 values as well. We've lost a lot of that premium due to California having avian influenza. California is a big producer of non-fat dry milk and skim milk powder, having milk production starting to look a little bit better. Output out of California on a powder perspective starting to tick a little bit higher, I think has started to ease some of the pressure on that powder market. And the rest of the world is seeing fairly weak powder prices. And I think the US needs to be in a bit better position to stay competitive if we wanted to participate in the export market. So there's a quick rundown on what we're seeing from a class 3 and class 4 perspective. But overall, it's been a pretty tough sledding over the course of the last few weeks.
Okay. Well, thank you for breaking all that down for us, Kathleen. I think we have plenty to chew on here. I think if there are two themes in today's episode, it's that A, the grocery list is getting long and it's time to make a run, and B, that there is opportunity and volatility in virtually all parts of this market. The fundamentals are offering some room for movement. And then, of course, we've got the geopolitical issues that are inevitably going to keep things moving around and difficult to predict. So, opportunity and risk both on the table, and you can manage that and capture some profitability while it's still on the table, while still remaining open to additional moves in your favor. So, plenty to work through here this week. I appreciate your time this morning, Kathleen.
Yeah, of course. And if you missed the grocery list, it's sumo oranges and anything protein.
There you go. Sounds like a good weekend coming up for us here. That will do it for today's episode of The Grain Feed. We would like to thank our Insights crew and Paige and Lexi for their production magic. And we would like to thank you, the viewers, for tuning in. We're always ready for your feedback. Tune in next time for another episode of The Grain Feed.